how do you decide whether to buy a certain stock?
We only buy stocks that go up. No, I think we, let me see if we can go back. We have it here. So essentially what we're looking for is three things. One is we want to buy great businesses. And we define great businesses as companies that have great customer economics, that they have consistent top line and margins, they have higher returns on capital, they have good to excellent cash conversion. And then the last one, which is very rare and we don't always find it, is the ability to redeploy capital incrementally at higher returns of capital. And we want to expose ourselves to these businesses by buying the securities, usually equities, of great companies, which we define as companies with management that is on our side, has a capitalist structure that's conservative without too much debt, and a management that has a history of doing good capital allocation. Because there's no point, most of the cash that those businesses end up generating will remain with the company. And as minority owners of these companies, if management takes the cash that's generated by the fabulous business and ends up redeploying it into a shitty business, then yes, we've generated the money, but then lost it immediately thereafter. And once we find these businesses and these companies, then we can think about the issue of valuation. And most of the time, they're not cheap. A lot of the time, they're not even fairly priced. And so we have to wait and follow them for months, years sometimes, until something happens that does not fundamentally change our opinion of them, but causes the stock price to go below what we think is a conservative value of those companies. So that's what we look for. But the actual way we go about it is what we call the process. And that starts, the first part is what we call killing the idea quickly. And that is an efficient way of saving time, or at least that's how it started, by saying no quickly. But then we discovered over time that getting yourself in a position where you start by looking by what's wrong and ugly puts you in a much better frame of mind to avoid confirmation bias. The fact that you're looking at a company or a stock already means that you're positively biased to start with. Otherwise, you wouldn't be looking. And so trying to find the red flags, which we start with, the first part we do is the quantitative ones, which are a very quick and easy way of saying no. And then the qualitative ones where we're looking for something that's qualitatively wrong. And if we can't kill the idea, then we dig deeper into what we call the deep dive. But at that point, we hope that at least we have overcome some of the positive bias that we went into the idea with. And at the very least, we started thinking about what's wrong. And that's always a good thing to have. In the deep dive, again, we're trying to answer the question, is this a great business and is this a great company? And if it is, then the last thing is trying to see how much do we think it's worth. Like I said, it's often not cheap at that point in time, which means we add it to a wish list, continuously follow it, continuously update the value that we think is fair, and at some point in time, hope that one of the companies on that list gets cheap and we can buy it. So that's the long answer, I guess, for that question.